Hello everyone and welcome to this week's FX webinar. My name is Craig Erlam, Senior Market Analyst at OANDA. Now, it's been a couple of weeks since the last webinar, and what a couple of weeks it's been. To be honest, it's hard to know even where to begin. For those of you who aren't aware though, we have set up a podcast in partnership with Jazz FM over the last few months. So aside from the webinars themselves, for those of you who are interested in the more fundamental side, you can actually check out our new podcasts. They are available on iTunes and on Android. On Friday, we were discussing all the events of last week, starting with the G7, which currently now feels like a lifetime away, the Trump and Kim summit, the numerous central bank meetings, and anything else really that was on the agenda. We also had a guest from our Singapore office, Steve Innes. So he was giving us the insight straight from Singapore and some interesting stories surrounding that as well. So like I say, available now on iTunes and on Android. It's called OANDA Market Insights. So I hope you enjoy it, and please do give us all feedback. It's always very welcome. I'll try and give a brief outline though on the events. We are seeing a lot of risk-averse trading at the start of the week. It seems that right now the trade continues to be a big issue. Again, going back to that summit, G7 summit last week, there was a lot of concerns about the fact that Trump refused to sign the accord. Initially, we saw a bit of a muted response to that. I think that could ramp up potentially going forward if we start to see tariffs and counter-tariffs between Canada and the US and the European Union and the US, especially if the Chinese ones are anything to go by. Obviously, the US imposed $50 billion of tariffs on China on Friday. This was reciprocated by China on the US over the weekend, an initial $34 billion being imposed with the potential for a further $16 billion. Straight away, Donald Trump has claimed that he has instructed his trade representative to find another $200 billion in Chinese products to impose a 10% tariff on. So this has really shaken markets at the start of the week. Markets really don't like the prospect of a trade war. It's a protectionist measure. It's bad for global growth. It's bad for domestic growth. You're harming yourself while harming your trade partners. Clearly, this is a tactic from Donald Trump just to get China back to the drawing table and find a way to reduce its trade deficit, which was a core part of his campaign to become president of the US. And he's clearly willing to make sacrifices in the near term in order to achieve this. And as we discussed on the podcast on Friday, coming on the back of a diplomatic foreign affairs victory in Singapore last week, despite the fact that we still don't know the exact details, and also coming on the back of a strong US economy and tax reform, clearly Trump believes he can make short-term sacrifices now for longer-term goals, even if it means adopting a far more combative stance with what is meant to be the US's allies in the process. The concerning thing right now is that while someone like North Korea while the measures that were imposed, shall we say, on North Korea are believed to have brought them to the negotiating table, it doesn't necessarily mean that that kind of stance is going to work in every sense. And this is the kind of impression that we're getting from China right now, that they will not be bullied, they will not be pushed around. And if the US is going to impose tariffs, then they will come back and impose equal measures against the US. And the European Union is very much of the same thinking as well. They may not be as aggressive, they may not be as quick in their response, but they will stand up for themselves. And this is something that the US is going to have to come to terms with, and Trump himself is going to have to decide how worthwhile this venture is going to be and what the chances are for a success. So this is going to continue to weigh over markets, I think, and we're very much seeing that risk-averse tone at the start of the week. We had numerous central bank announcements last week, few surprises. The Federal Reserve raising interest rates was no surprise, adding in that fourth rate hike for this year in the projections was a slight surprise, but overall it doesn't really change the bigger picture. The ECB announcing its intention to end QE at the end of the year, reducing asset purchases from 30 billion to 15 billion for the final 3 months. Again, no one's surprised at that announcement itself. People maybe thought that they were going to hint at such an announcement and wait a month in order to do so. So the announcement itself came a little earlier. I was quite surprised that already discussion about interest rates, saying they won't come till the middle of next year. A lot of people anticipating later on next year, before we would start to see interest rate hikes from the ECB. I thought the most interesting thing from that really was that interest rate nod to interest rates. But as we often see from the ECB, they are a hawk wrapped in dove's clothing. They take what is a hawkish announcement and they add layers and layers of dovish rhetoric, so in order to manage the euro and manage yields. And that's exactly what they've done. That's exactly what they've achieved. The markets have bitten again, and the euro is heading lower, despite the fact that this is a hawkish policy move from the ECB. And now this week, we've got plenty more on the central bank slate. So that's very much the key theme again this week. We've got the Bank of England decision on Thursday, as you can see on the economic calendar. For those of you who don't know what this is the economic calendar, which can be found on the OANDA MarketPulse website. That's marketpulse.com on the economic calendar tab at the top. On the home tab, you can see all the latest articles we've been posting. My most recent one, ahead of the US Open, posted just about 20 minutes ago. And as you can see, we've got the Bank of England on Thursday, so that's the key central bank event, a central bank announcement this week. So that will be one we'll be keeping a very close eye out for, particularly as the Bank of England previously alluded to a rate hike in May, which they never followed through on. Very unlikely to follow through on it today, but we could get signals about the potential to do so later on in the year, which is still relatively heavily priced in. The last time of checking, it was around 80% priced in by the market. So market's still anticipating a rate hike this year, despite the turn that we've seen from policymakers, despite the fact that the data doesn't necessarily support it this year. While that's the key central bank event in terms of a monetary policy announcement, though, you'll be able to see here we are riddled with central bank speeches this week. Yesterday we heard from William Dudley, Raphael Bostic, Mario Draghi, new Bank of New York Fed President John Williams, who replaces William Dudley as the in New York. We've already heard from Mario Draghi today. There wasn't really too much to Draghi's comments earlier on, very much just a rehash of the comments which we heard last week. We have got scatterings of data like housing permits and housing starts and building permits, but really it's all about the central bank speeches this week for me. You can see we've got more ECB policymakers on Wednesday. Wednesday's really interesting as well because at 1:30 we will hear from another number of central bank heads. So you've got Jerome Powell here, Mario Draghi, Philip Lowe from the Reserve Bank of Australia, and I don't know why this calendar's missed it off, but earlier on this week, I believe it was showing that we were going to hear from Haruhiko Kuroda, the head of the Bank of Japan as well. So that will be a very, very interesting event, having potential ramifications for currency and bond markets in particular. So that's certainly one to keep an eye out for. That's 1:30 GMT on Wednesday. So certainly, in my view, one that we should be watching, keeping a very close eye on. You should remember this is GMT, so add 1 hour if you're in the UK, so that'll be 2:30 UK time, I think, in the UK, and which would be 9:30 if I'm not mistaken, over in New York for those of you who are listening over there, and also in Toronto. Again, scatterings of data, so existing home sales, but really it's all about the central banks this week. And then heading into Friday, a lot more data, fewer central bank speeches, things like PMIs in the morning, inflation and retail sales data from Canada in the afternoon, and more PMIs to wrap things up. But I think the important thing on Friday is going to be this OPEC meeting. With inventories having, I know this is an FX webinar, but I will just touch on this, with inventories having fallen in line now pretty much with the 5-year average, we are going to likely see a change in tone from OPEC and non-OPEC members who have participated in the production cut that's been in place over the last couple of years. that means that we are likely, even with the sanctions that have been imposed on Iran and the impacts that will have on outputs, the limitations to output that we're seeing in Venezuela because of the crisis there, we are still likely to see plans being discussed for the exiting of this production cut, probably being slowly phased out, maybe say around 500,000 barrels by come the end of the year, or maybe a little bit more. And that's what we're seeing currently being priced into oil, which has come off its highs. I say that this is a commodity move, so I wouldn't normally talk about it, but it can also have impact on commodity currencies as well. So it's certainly worth paying attention to for those of you who trade the Canadian dollar, for example. So that's your events this week. Like I say, heavy central bank focus. So I think FX markets in particular, bond markets also could be very interesting this week. But the other thing that's really impacting currency markets, which is going to be a key theme throughout this, is that risk-averse tone. So that's heavily favouring the yen pairs, which we'll get to towards the end. We're also seeing some support for the US dollar, despite the fact that it is effectively initiating this trade war. And sometimes when you see this being a US economic story, particularly a story that can have negative implications for the US economy, it doesn't necessarily offer much support for the US dollar. But we're very much seeing that now. You can see that 10-year Treasury yields, for example, have dipped below 2.9% from around 3%. Because of the safe haven flows that we are seeing. That has helped us strengthen the dollar, and in turn contributed to the weakening of other currencies. It's also led to the weakening of gold, which again I won't be touching on today, but traditionally a safe haven, but limited upside because of the moves that we are seeing in the dollar. Perhaps one of the reasons why the dollar is being seen as such a safe haven is because of the weakness we're seeing in other currencies, say the euro and the pound. The euro in relation to the recent rhetoric from the ECB on Thursday, also potentially because of the political concerns that people have right now. Angela Merkel's position is looking increasingly shaky because of the migrant and asylum seeker situation and the backlash that she's receiving on the back of that, particularly from the opposition AFD party and then members within her own coalition government, particularly the CSU. There's also the Italian situation, which continues to be a concern, despite the fact that they have been adopting a far more pro-Euro tone recently. The situation in Spain seems to have settled down a bit, but you wouldn't be surprised if we see the announcement of elections in the not too distant future there. And also the fact that we are seeing slowing growth in the euro as well. So these things have been negative for the euro. The pound, of course, has its own issues. The Bank of England adopting a less hawkish tone, but also these Brexit concerns. We're now seeing the bill pass back on the Brexit bill pass back, the amendment to the meaningful vote term about whether Parliament gets a meaningful vote on the final deal, not just a vote on no deal or the deal which is on the table, but also an idea that they can send Theresa May back to Brussels to renegotiate. Doesn't really work, I don't think, personally, both in terms of practicality and also it probably, you would think, would weaken Theresa May's negotiating hand. But this is something which that is being pushed for because at the end of the day, we are a democracy, and Parliament believes it should have a say, and the entire future relationship of the UK with the EU shouldn't be determined by such few people, which is extremely fair. This uncertainty surrounding Brexit and the fact that we have more talks with the EU in the next week and a half, and it doesn't seem that there is a solution on the Northern Irish border, this delay to Brexit, this continued uncertainty does again appear to be weighing on the pound, and we're seeing another sell-off today. It's broken back below 132 and is coming under some pressure, currently trading, as you can see on the chart, around 130, sorry. So these are the key themes, I guess, right now. We'll look a bit closer at the charts. I hope that was a decent summary. Like I say, please do check out the podcast for more in-depth analysis, both from myself and Steve Innes at the This Week and Johnny Hart from Jazz FM. Hopefully, though, that was a relatively good roundup. In terms of the actual charts, as I say, the dollar has very much been strengthening, and the euro has very much been weak since Thursday, which you can see here was when the central bank meeting took place. We were trading from around 118 back to 116, so clearly a lot of dovish rhetoric from Mario Draghi. I'm sure he'll see that very much as a job well done. While you can't read too much into the technicals around these central bank events at times because of the impact that a certain comment can have, you can see that we did have a nice little topping pattern here with the neckline around 117.30, the top really forming here around 118.40. So the break of these 117.30s was quite significant. 110 pip move, distance between the neckline and the high here, and that was quickly, which gives you a possible price projection, and that was quickly achieved shortly after the meeting, which would have brought us down to around the kind of 116.20s, and we've even achieved more. So this just looks like consolidation to me, and we have seen another sell-off this morning, so this continues to look weak. We have got stern support being tested around the 115s, which if we go back to the daily chart here, you can see is long-term support, this kind of 115.50, 115 level. This is long-term support. More interesting for me is just shy of here around 114.50. Again, prior resistance in this area here, the 50% retracement of the longer term move from the lows to the highs. And again, I'm not even convinced it's going to stop there. I'm keeping a close eye on these indicators here because we are seeing divergence now forming between. You can see the MACD histogram is failing to make lower lows. We're now seeing it starting as well on this moving average. Of course, we haven't made lower lows in price yet, so it's hard to judge, but that doesn't fill us with much hope. The stochastic is still falling looking relatively okay. For me, I'd like to see it come back at least somewhere into this region here. 113, I think, is a very interesting level. But it'll be intriguing to see how we do respond at that 50 fib, especially if we do have these divergences forming with the MACD, the stochastic, with price. Cable, again, is also looking very weak. Again, my outlook really for this hasn't changed. We've made new lows today. It's still looking very weak. Again, we're seeing some kind of divergences potentially forming here, which suggests this trend, which started back here, is running out of a little bit of steam. I still think we can hit these kind of 130, 130.50s. That's, again, a very interesting level for me. 50% retracement. This will give us the completion of the move of this big double top, which was an extremely ambitious move, which we're very now close to seeing play out. We're around 100 pips away at this stage, and it's also long-term support and resistance as well. So this is an extremely interesting move to me. If we are going to see a dollar resurgence, then this could be a very if we are going to see the dollar run out of steam, then I think this 50 fib level, this 130 to 130.50 is going to be an extremely interesting level as far as I'm concerned. And there's nothing really too much more to add to that. I just think that's a very interesting level, and we'll see how that goes. Euro sterling, I've got nothing to add, to be honest, and I don't want to waste people's time talking about a currency pair that's just so choppy. When the pound's weak, the euro's weak at the moment. When the pound's strong, the euro's strong, and you get these choppy markets in the cross between the two. If you're a range trader, then this is perfect. These are ideal circumstances for you. You've got the lows around these kind of 87s, the highs around the 88.50s, and we're just very choppy in between these levels. It doesn't really do much for me, this pair. So unless anyone wants me to linger on it for any reason, I will just move on. Aussie dollar is far more interesting. We've seen a big drop off as part of this renewed dollar strength, which we've seen. We did retrace a little bit further than we were looking at. We were looking at this kind of 50 to 61.8 fib as an interesting correction from the previous high to the previous low, combining prior support and resistance along the way. We got slightly above here. This is, again, as we always say, markets needed a little bit of room to breathe. Whether that was a little too far, I'm not too sure. But we've seen a nice now move lower, breaking below the previous low, and this is where the real interesting test is for me, because we're now at long-term support. So that's where we get a real interesting test. And you'll note that what I'm saying here with a number of these now, these dollar pairs are seeing the dollar testing long-term highs in that particular pair, or long-term interesting levels in that pair. So this is where we get the real test. Everyone talks about how long is this dollar resurgence going to last. Is this a sign of things to come? Are other banks becoming dovish just as the Fed's getting hawkish? Is the Fed raising interest rates a sign that the dollar strength is going to continue and continue and continue? And for me, this all along has been a dollar correction, not a dollar driven positive move and a long-term continuation. The dollar from the start of 2017 was weakening up until the start of this year. What we've seen since the start of this year is a correction in the dollar rather than a continuation of a longer bullish move, in my personal view. And it's around these levels that we start to get that, say, a real test of that. If the Aussie dollar breaks below here, then that looks like it could potentially be a signal of a potential move back towards these kind of 72, 71.50s, which is, again, long-term support. And that is possible. Don't get me wrong, that's very possible. But you can see here again, I'm wondering about the momentum in this move, because we are making lower lows in this Aussie pair, and yet you look at the MACD moving averages here, and we're just not doing that from the previous low. So this is potentially another sign that the dollar move is running out of a little bit of steam. This looks very aggressive though, so I wouldn't be surprised to see the Aussie dollar make that extra leg lower. I'll be very interested to see what kind of bounce we get at this level, and then what if we can get a test of these, say, 75s. But all of these momentum indicators on all dollar pairs, for me, look like they are signaling a potential the rally in the greenback is potentially running out of steam. Not a sign that the people are pricing out interest rate hikes or anything like that. More a sign that they're just priced in, and once they're priced in, if 5 rate hikes in the next year and a half are priced in, and 5 rate hikes happen, then there's nothing left. If that makes sense, the markets are on side. So you wonder whether this is what we're seeing a sign of now. I guess we'll wait and see over the next couple of weeks how that plays out. But for me, while this particular pair potentially could see moves back towards these 71, 72s, I'm very much intrigued, shall I say, about whether the dollar can keep this up. Dollar CAD similar to Aussie dollar. And this is where I said the links to oil and things like that. Oil coming off its highs seems to have coincided with the Canadian dollar losing its spark. I still think I was looking at the interest rate probabilities to the Bank of Canada before I came in here, and markets are still pricing in comfortably 1 rate hike this year, a little bit over that. We're not seeing 2 priced in this year, which I find quite interesting, because a few weeks ago, a second was pretty much priced in for the year as well. So clearly there has been a step back in rate hike expectations for the Bank of Canada. Potentially this trade spat with the US is having an impact on this. The NAFTA negotiations not potentially going particularly well, and oil prices coming off is potentially feeding into this as well, and feeding also into the Canadian dollar weakness. But again, the dollar is now hitting these kind of 132, 133 levels, potential areas of resistance. Not necessarily seeing the momentum falling out of this one yet, which potentially suggests that the Canadian dollar is playing a part as well. If we do see a rotation off this resistance level, then 130, 131 becomes an interesting area of potential support, and a break through this 132.85 to 133.50, then 135, 136 becomes an interesting area of resistance above. But again, I'd say oil prices is something worth keeping an eye on here, but I'll be interested to see how the dollar side of this plays out also. You can see that even the pound has made decent gains against the Canadian dollar, which does suggest there is a big Canadian dollar influence there. And again, just to reiterate the previous point, potential that oil, the drop off in oil is having an influence here. It'd be great to see a move back towards these kind of 77.35s, a nice 50% retracement test, prior support as well. Also testing the upper end of this moving average from below. I wouldn't be surprised if we don't though. 175.75 seems to be an interesting resistance at the moment. Maybe get up to kind of 177s, maybe just shy. But I feel like this moving average could potentially cap on the upside, just like in the near term, the 202.33 day simple moving average capped any drop to the downside. A rotation off the moving average band, though, is a nice confirmation of that initial break, and then potentially bearish sign for now. So nice technical move. I'd like to see a little bit higher, but I wouldn't be surprised if we do just rotate lower around these current levels. Kiwi dollar, again, testing lows. Similar to Aussie, similar to CAD. This is one that's very much not faring well against the US dollar. But again, we're still testing these lows around 68, 69, and that continues to be a key area of interest for me. Momentum doesn't necessarily suggest to me that we're going to see a break, but if we do see a break, the momentum could quite easily pick up, which is why we always say that these momentum indicators are a supportive indicator, they're not a leading indicator, because price action will ultimately dictate, and should we see a break at this level, then momentum indicators can quickly tell a different story. But this looks like long-term support for me. This looks like significant support for me. So I think a break at the kind of 68s would be would take something quite significant and would be a very technically significant breakout. And then technically, again, you're looking at a kind of 67 type level for if you're looking for an area where we've previously found support when we've previously been trading below those levels. I'm not sure it's necessarily got it in it to make those to make that kind of move, but again, an interesting one to monitor over the coming weeks. Now the yen pairs are very interesting all on their own. The dollar has been a safe haven currency as of late, not quite as much though as the yen. So you'll see that the dollar's been making solid gains against most currencies, but against the yen, it's very much not been the case. The yen is your real safe haven currency. This is one which you do see a lot of flows into when in periods of risk aversion such as this. So the dollar is actually trading up on the day, but against the yen, it's very much trading lower. And we are testing some support here. This is more of a speculative trend line just to try and gauge if we are going to see a break and a retest of this cloud. Not the most interesting chart for me, to be quite honest. We do have longer term resistance here where we have run into previously, and again, just shy of that previous high. I just don't think there's an enormous amount going on in this chart. So yes, if we see a break of these kind of 109.30s, then you could potentially be signaling a move back towards these kind of 108s. And again, we'll get the fib levels on there and monitor that, see if we do rotate higher. But price action is above the cloud. The lagging line is above the cloud. But we're still a little bit choppy. And the longer this kind of risk aversion remains in the markets, the more susceptible we are to these kind of rallies and then rotations lower. So if I'm honest, from a technical standpoint, not really the most interesting chart for me right now. Sterling yen, on the other hand, big risk aversion moves and big drops to the downside. The pound again really struggling today, particularly so. You're seeing a currency that's struggling against a currency that's thriving. So that's why we're seeing obviously these sizable moves. We saw the 38.2% retracement. I said last week, I think I was hoping for a 150 test, but clearly Donald Trump had other ideas when announcing these tariffs. So we've come off the 38.2, and it seems we're heading back lower, back towards these kind of 143.20s. Near term, next couple of weeks, I think is going to be difficult for this pair. I think there's plenty of potential for risk-averse markets over the next couple of weeks, and with Brexit negotiations stalling, and the Bank of England not offering support to the currency, I think the pound does have the potential to struggle. So I think this 143.20, 143 could come under a little bit of pressure. So you could be looking at a break below those levels earlier than may have otherwise happened, should we say. In that case, then these kind of 140, 150s become interesting as they were back here. But even below there, whether we can achieve these kind of 140s in the near term, I'm not too sure. We'll have to see if we pick up some momentum on a break below here. Momentum again does look to be slowing a little bit, even if we've had this one big sell-off day, which is being represented by this nice long red line on the stochastic. But again, the difficulty with these yen pairs is that you're very vulnerable or very sensitive to risk appetite in overall markets rather than broader themes, broader trends. Same goes with euro yen. Euro struggling, yen very much doing very well in these risk-averse markets. We've seen a rotation slightly shy of 50 fib. I'd like to have seen a test of that. Never mind. We fell short at around 130.42. Can't blame Trump this time, but we can blame Mario Draghi and ECB for wrapping the hawkish remarks, wrapping the hawkish policy move in such dovish clothing. Anyway, we have seen a rotation lower. From a technical standpoint, this is looking quite bearish at this stage. Looking back at this 4 hour, chart, you can see that we've got this kind of neckline here around the 128.15s. Nice clear top there, so that's a lovely little technical double top here around 130.30. So that gives you a double head. It's around 215 pips in size, which gives you a possible price projection at around 126, which hasn't been achieved yet, but doesn't look far off being achieved. So we'll see how we trade off the one. If we get to the 126, we'll see how we respond off of those levels. Again, on the 4-hour chart, this is looking like it's lacking a little bit of momentum potentially, but we'll see how it reacts off of those levels. Again, sometimes quite difficult to judge in these markets when risk aversion and risk appetite is such a massive driver of these currencies. Okay, I think that's all we've got time for today. Hopefully I've covered everything you wanted to cover. For once, we're actually finishing on time, so that's great. As always, thank you very much for joining us, and the best of luck with your trading. And again, just to reiterate, if you want to get more analysis, you can find it on the MarketPulse website, marketpulse.com. If you've got any questions for me, then please do just follow me and ask me on Twitter. Always happy to come back. That's Craig_Forex is my username. And finally, please do subscribe to our podcasts, which we put out every week. Been working very hard on them, and hopefully you find them very useful. OANDA Market Insights now available on iTunes and on Android. But again, thank you very much, and I hope you have a fantastic week.